I'm Todd Pigott, president of ZINC Financial. We are also one of the largest fix and flip operators throughout Central California, having rehabbed in excess of 400 properties in our lifetime. How I quickly analyze a fix and flip deal and how you can too. Last time we talked about the biggest mistakes new rehabbers can make. Today I want to show you how to evaluate a fix and flip deal in just a few minutes. Knowing how to spot a profitable property fast is what separates successful, scaled operators from those who struggle. I've been flipping properties for years. I actually started in 1996. And even now, as the CEO and president of ZINC Financial, I still actively invest in real estate. Over time, I've developed a simple but effective process to quickly analyze your deals. So let's dive in. The 70% rule. It's a quick litmus test. Absolutely, to tell if your deal is going to be profitable or not. First, I start with a quick rule of thumb, the 70% rule, maybe 65%, depending on areas. It's a great way to identify instantly if the deal is even worth pursuing and having negotiations or not. This is how it works. You take the after repaired value of the property and multiply it times 70%. That's the highest point you want to be at after you've rehabbed, carry cost, and operating cost. That's the maximum you should pay for the property. Example, ARV of $300,000. 70% of the ARV is $210,000. Rehab costs are $40,000. Carry costs, another $10,000 or $20,000. That would make your maximum offer price somewhere in the $150,000 range. Now let's take it a step further. There's also return on investment, which is your return over a period of time. So the 70% rule isn't used all the time, it's a guide. Let me explain. If you can make $15,000 or $20,000 on a house, but it's just a wholesale where you're just going to fix up the honeydew items and then retail it out, you might do that one for a lot less because it's only going to take you a week or two. However, a rehab with major structural, roof, or HVAC, you might need to be more conservative because it's a 6-month project. So how we look at deals here at ZINC is always on investment over a period of time. We look at the maximum ARV, we deduct our costs and carrying costs and get down to a maximum offer price. And then what's most important is we estimate how long that project is going to take. Because $20,000 over a week is a lot better than $100,000 over a year. If a property is priced this way, it's usually not worth pursuing above the 70% rule. Understanding the true rehab costs. Let me talk to you about that. One mistake I see investors make is underestimating renovation costs. You can't just guess. Getting accurate numbers is absolutely paramount to your transaction. I always break it down into 3 categories: cosmetic, structural, or hidden costs. Cosmetic, paint, flooring, finished plumbing, kitchen upgrades. Very simple and predictable. It's very simple because you're just buying that product at Home Depot and installing it. So it's very, very easy to figure out what that costs. Structural, roof, foundation, electrical, major red flags that can be missed. Hidden costs, this gets a lot of investors in trouble. Permits, holding costs, evictions, squatters, unexpected repairs. Always make sure you have a 10 to 15% contingency on the project. If you don't factor in the contingency or accurate rehab costs, it'll eat into your profits very fast. Neighborhood and market trends. Very, very important. Location. There are 2 things that I cannot stress enough: the front elevation of the property and the conforming of the property within the neighborhood. Both of those are extremely important. The elevation is pop-outs, roof lines, gable, hip, things of this nature. These types of frontal elevation views of the property cannot really be changed without major construction. So you want to make sure that that frontal elevation view is consistent with the neighborhood. Separately, conforming to the neighborhood, is the property next to other homes? I call it my curbs and gutters theory, where if a property is next to a commercial building or railroad tracks, not so desirable. It is absolutely paramount that the elevation of the property is conforming to the neighborhood and the property itself is conforming to the community. Even if the numbers look good, the neighborhood still has to support the deal and conforming. Here's what I look for: comparable sales. Are they similar homes selling fast? Is the absorption rate in that area good? Supply and demand. buyers actively looking and seeking properties in that area. By the way, if I can't sell it, can I rent it? Go to Rent-O-Meter or Rent Exchange and view rental rates to make sure that the property cash flows in the event that you can't sell it. A great deal in a bad location is not a great deal. You cannot change the community and you cannot change the frontal elevation. If you can quickly analyze a deal using those 3 steps, you'll avoid bad investments and bad deals and find properties with real potential and real profit. If you're serious about scaling your investments, having the right financing partner is key, absolutely key. You must choose a direct lender, a real lender with their own cash. A broker is just simply relying on somebody else to fund that transaction. At ZINC Financial, we fund deals very fast, typically less than 10 days, so investors like you don't miss out on opportunities. If you're ready to get your next deal funded, visit zincfinancial.com or reach out to us today at 559-326-2509. Thank you.